Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kostrup-Larsen.
Welcome back to the latest edition of Top Traders Unplugged, where each week we take the pulse of the markets from the perspective of a rules-based investor. It's Alan Dunne here, sitting in for Niels this week, who's away. Delighted to be joined by Cem. Cem, how are you? How's all in Chicago?
Doing great. Fall in Chicago is always beautiful. So the leaves are changing colors and the kids are back to school. So yeah, things are good.
Good stuff. Noticing any impact from the shutdown or not yet?
Not really. I mean, more like here in Chicago, the ICE agents and those things don't seem to have shut down at all.
Okay.
I went to Wrigley Field yesterday, and there were helicopters circling from ICE agents. It's really kind of a bizarre situation.
Okay. Wow. Interesting. We like to kick off with asking what's on your radar since you've been last been on. Plenty going on. There's no shortage of things to talk about. Anything standing out?
Oh, I mean, obviously you can't really ignore kind of some of this, the political. I hate the word political because it's not really political, but the governmental changes that we're seeing. So I think that's starting to, markets don't care about that till they kind of do. And I think those are starting to have structural effects. And I think that's all going to really accelerate here into the midterms next year. And I think markets will increasingly probably focus on what's going on there.
Okay, but I think that's definitely part of what we will get to as we go through the conversation. But maybe just to kick off, set the scene, give a quick recap on performance. It's kind of positive month for pretty much everything. We seem to be in the midst of a bit of an everything rally, and fortunately, managed futures CTA is participating as well. So, in terms of trend following and managed futures performance on the month, SocGen CTA was up 3.82%, leaving it down 2.66 on the year. SocGen trend up 5.66 on the month, leaving it down 2.32 on the year. BTOP 50 up 3.5% on the month, and actually positive on the year, 66 basis points. And the short-term traders index was up 1.4, but still down 5% on the year. I mean, outside of that, as I say, it's the relentless ongoing rally in equities. The MSCI World up 3.3%, and the S&P 500 up 3.6%. The real standout, I guess, on the month was gold, up close to 12%, and it's been obviously a phenomenal run in gold, and I have a feeling that's also something we'll get onto. But I know one of the topics, very, very timely you wanted to talk about was bubbles, and when you look at those numbers, I mean, okay, maybe the equity numbers this month are strong, not exceptional, but we're just seeing relentless gains in equities. We do hear talk of a bubble from time to time, maybe not as much as we might have in the past, but I mean, how do you characterize where we're at in this bull market now?
Yeah, so I've always used the analogy that, to be clear, that valuations are, first of all, not a good timing mechanism, right? There's a lot of research that says fundamentals have zero predictive value over any period less than 10 years. And that's that blows people's minds whenever I say that. But now over 10 years, it does. It starts to become much more predictive. And the way that operates is markets are a function of liquidity. I've used the analogy that, you're on an airplane, how far off the ground are you? That's the fundamentals. So if you're at 60,000 feet, that doesn't mean you're going down. But it does mean that when the gas stops going, right, that there's a long way down. And eventually, if you wait 10 years long enough, the gas runs out at some point. Something happens. And generally when that happens is when the mean reversion to fundamental values happens. So I really, really think of valuation as a risk management tool. Okay. So bubbles happen, and they're going to happen, and you're going to go to crazy heights because it's not what drives fundamentals, is not what drives the outcome. And so we shouldn't be surprised that we're here again. I think I will say a naive me in 2001, 2002. Again, I started in 98. After the bubble burst in 99, 2000, would have never have thought we could get back there, because quite simply it seemed just so obvious. The valuations were crazy, and then you saw an over 90% correction in the Nasdaq. Right? How can that happen? How can markets be that inefficient and make the same mistake again? Here we are, and it's not really a mistake, right? I want to be clear, just the way markets work. I've learned a lot in the last 25 years, and the reality is, you've heard all the sayings like, markets can stay irrational longer, you can stay solvent. It's because it's not really irrational. It is markets are rational in the sense they just operate based on supply and demand. And supply and demand often, actually most of the time, has little or nothing to do with fundamentals. And so here we are, right? And what's driving the supply and demand? Record structured product issuance, short interest, so that structured product issuance compresses volatility and allows for a lot of these other flows to move forward. Short interest, a lot of that from the size and growth of hedge funds, and a lot more kind of relative value investing out there. On top of that, we've talked about this before, but there's a momentum releveraging effect, not only from passive investing, but from all investors who operate with massive leverage, and that leverage means reinvestment on an ongoing basis. You can add these all together, and if the market stays under control with the vol compression, we're just going to glide higher. Lastly, I talked about the top. You have an administration that is super incentivized to keep pushing that gas and providing that plane with fuel. And so at some point, they may not be able to. And we'll get to what those instances are and what drives the final end of a bubble. But, this in my mind is 98, 99. And you have to play accordingly. And the way you play that, I was fortunate enough to get that experience early in my career, is incredibly different than any other market. And there is a ton of real edge by playing the distribution, which is really mispriced as a function of those realities, that supply and demand imbalance at the end of this bubble. So we can dive into that if you'd like, but
good starting point. I mean, the late 90s analogy is always interesting, and it, obviously fairly obvious in some respects, in terms of the magnitude of the gains in technology stocks, and I guess the late 90s, the annual gains were probably even greater. We had a pullback in 98 of the LTCM, but we've had a correction this time around in 2020. We've had another one in 2022, obviously dips in 24, 25. So we've probably, this rally has been punctuated even more, even though it has been more resilient. There are differences from a macro perspective as well. I was talking to somebody this week about it. The deficit is one big difference. The US hit a surplus, I think, in just around 99 or 2000. So that's, and we've got tariffs in the mix this time. So that's another thing. And what came with the IT spend in the late 90s was that productivity boom. It was for real. Growth was much stronger. This time around, growth is solid, but it's not as strong, and productivity has been kind of up and down. So definite parallels, but some differences. I guess you're zeroing in on the market dynamics as the major parallels, I guess. Is that fair to say?
Yeah. Yes. I'll add to what you said. So the same and yet different. The inputs for a bubble to really get to these heights, right, is a liquidity push. And in 96, we had the lowering of the natural rate of unemployment and Greenspan coming in and really changing the liquidity dynamics. Here, again, we have a historic change in how we provide liquidity. We're getting a loss of Fed independence and a takeover of the Fed and a willingness to do something bigger and different and do it proactively, regardless of the inflationary kind of outlook as well. So those two are parallel. Another thing you obviously need is a narrative. You need a narrative that is by the broad mass. People are able to at least suspend some historical reality, are able to say, this time may just be different. The internet was big enough for people to say, well, this time this may just be different. Well, guess what? AI is big enough for people to say, you know what? AI is different. This is going to change. You cannot use the same rules. Okay. We have those things. And that's a big part of why we're here at the core. But you also, this time to your point, have actually more risks, well-known risks, some of which you mentioned, a deficit. Again, we were in a budget surplus in 98, 99. We had just become, meaning the United States and the West broadly had become the world hegemon. The USSR had just fallen apart. There was no rival in terms of economic strength, military strength, anything. So the U.S. had absolute control in a sense. I think it's safe to say that's not where we are today, right? So there are some big differences. So given those risks, it's actually even more, I don't say concerning, but you have to look at this and say, how did we get here? And the answer is more absolute control from government than we had back then, and ability, despite those risks, to yield a much bigger set of tools to keep things going. And lastly, they have the help of a very different and changing market structure because of those risks. And those things we can get into, I think they're very important, but they are, again, the structured product issuance and the move to other vehicles and more non-correlated things, a lot of things that you and I talk about, Alan, that are driving, actually, ironically, reflexively, market support as well. So yes, very similar. The things that drive it at its core are the same, but the risks and the things counteracting those risks are bigger. I often talk about a sumo market, right? A market where you can have two tectonic plates or two sumos pushing against each other. That doesn't mean they're either is going to yield or something is going to happen right away, but it means the potential energy for when something does shift is dramatically bigger. And that's the environment I think we're in today.
Yeah. You mentioned the word reflexivity or reflexive, which I think is really important in these scenarios, because obviously we know about bubbles and feedback loops, and Soros had this reflexive theory about which encapsulated the the idea of feedback loops. But even more than that the market participants make an error in their judgment, and because they misinterpret or don't see a kind of a fundamental flow in the argument, the market continues higher, and that improves the fundamentals until they see the flow. Do you see something here? Is the flow the AI spend, or what do you think?
100%. So the idea of reflexivity, we could probably do a whole episode on that. It's so important. Soros talks about it in real generalities, but there is a practical, measurable. And that's a lot of what we do with the dealer flow stuff we talk about, right? There's a measurable reflexivity. If you think about it, it's actually very logical, right? The biggest provider of liquidity in markets, and we know markets are about supply and demand. So if you really want to predict where markets are going, try and understand the supply and demand dynamics, right? And the biggest and most predictable thing in supply and demand in the market is the potential buyers and the potential sellers in weight, which is positioning, right? So if the world is long, guess what? That means you have a bunch of sellers and not very many buyers left to buy, right? And if the world is short, you have the opposite. But the same applies to options. So if everybody is hedged for a 3% decline, but not a 7% decline, guess what? The 3% decline is probably not going to come. And if it does, you're not going 3%, you're probably going 12%, right? The realities of positioning are, by definition, potential energy for the opposite. And that's what reflexivity is at its core. We can talk about ideology and philosophy and all these other things, but if you want to actually understand the mechanics of it, It's whatever the way people are positioned. And that's what a wall of worry is, right? Again, if people are worried, that means they're underweight the market, which a lot of just recently happened, right? They're worried because of the risks. And not surprisingly, that can lead to people being forced back in. And that's exactly what's happened throughout the summer and it's likely to happen into the end of the year as well. So that concept of reflexivity, when you really boil it down, is actually quite simple. If something swings one way, guess what? It has better odds of swinging back the other way. And it's not just because of the swing, but now you have potential energy, right? Because it's also in another direction as well. So critical. And in this environment, I can give you one really interesting example of reflexivity that's really driving. We've talked about structured products. And this really ties into, may take us over to precious metals and crypto and stuff as well. But there's this massive thing happening, which is there is a $500 trillion long market, which has expanded dramatically as the markets have gone up. That expanded, and we've gone into this bubble, right? We get long and we get increases in these valuations as we go. But meanwhile, everybody's getting to a valuation where they're starting to look around and they're starting to see the risks and say, how do I diversify? And that's a lot of what we talk about here, right? But that's been happening for 3 or so years, since 22. And because people saw that correlation breakdown between stocks and bonds. They're like, well, we don't have any diversification. What do we do? And you tell me, Alan, how do you diversify away? I mean, what are the ways, right? That's a lot of what we do. And there's small doors. The reason people do stocks and bonds is because they are very liquid and very easy to implement. But in our world, right, you need tools. You need it's harder to deploy diversification. And what that's led to is a boom in the last 3 years in our broad business, which is non-correlated strategies. Hedge fund assets have gone from $2.5 to $4.5 trillion in just 3 years. By the way, it's very stable at 2 to 2.5 for quite a while before that.
Yeah.
You've seen a growth in structured products. Again, non-correlations, the use of options to get some type of other positioning other than just long the market and, and short bonds and long bonds. And ultimately that has gone from 500 billion to 2 trillion as well. And so, wow, okay, these are all growing.
In structured products, is it?
In structured products. Quadrupling of size of the annual issuance in 3 years.
Where is that just, as you say, a diversification flow, or where is that money coming from?
100% it's a diversification flow. I mean, it's coming from primarily a retail world through RIAs, through the RIA channel. But these have been huge, investments in Asia, as you know, for a long, long time. And those flows from Asia continue to increase, but now the West is waking up to them. And the West is waking up to them because, again, how do I manage? I mean, it's the big question everybody's asking. How do I manage a bubble? How do I manage when valuations are like this? And by the way, at the same time that interest rates may not help me, bonds may not help me. How do I manage it? And the answer is you can use options, and I talk about a lot in different ways to structure more capital efficiently and more non-correlated. And that's what a structured product is. It's taking options positioning, making it an easily translatable kind of, this is my payout, which is different than just long, right? And it's allowing people and RIAs to kind of diversify. So 100%, that's where it's coming from. And again, it's the same thing that's getting people into hedge funds, right?
But generally on the structured product side, they are kind of autocallable type structures, or more selling volatility than buying. That's fair to say?
Correct. Yeah. And by the way, in that 2 trillion, a lot of people are like, where are you getting that number? It also includes ETFs that are issuing similar structures. I'm also including like buffer products, all kinds of things that are essentially the same thing in different wrappers. And so those are each growing. And I want to now tie this into another dynamic, which is similar but different, which is it's also what's driving precious metals. It's also what's driving crypto at this point. And it's not a coincidence that how much increase of assets have we seen in hedge funds? Okay, about almost a doubling. How much have we seen an increase in structured products? Almost a quadrupling. How much have we seen in the increase in the valuations of precious metals? A threefold increase. How much of a valuation increase have we seen in crypto the last 3 years? About a threefold increase. If you take all of those assets, by the way, and you sum them all together, all of these non-correlated, whatever however you want to look at them, assets, some type of a way to offset risk and concerns about your long positioning. How much do you have? 4.5 trillion, 2 trillion. Gold is now about 4.5 of, there's 7.5 out there, but most of it's in vaults. Let's call it 4.5 is what the liquidly available is, right? That's 11. And then crypto's another 4.5 or so as well. So about $15 trillion that we kind of generally throw our hands around it versus 500 trillion on the other side. And people keep asking me, well, is the precious metal kind of thing, the crypto thing, like, where are we? Are we almost like, look, this is a tripling. This is crazy. How could this possibly go further? You tell me, how are people when they really, and by the way, this is at market with markets at all-time highs, and everybody's saying, well, what happens when the real kind of, we see a 22, but worse in some ways, in one way or another, right? And so the move towards more non-correlation is upon us. It's happening. I would say we're in the second or third inning. Likely a decade from now, all of those assets will have much more. Now, the 500 trillion also might be lower, hard to say. And also to look at nominal versus real and all these things as we move forward. But I think, the reality on those products, obviously 2 of those are assets you can buy and benefit from that. And that's why those things are also, and they're more liquid and easier to access in some ways. But I think as hedge fund also strategies become more liquid and available, which is happening, I think those will continue to expand as well. And then structured products will become also much more available. I have a deep thesis that AI is going to unlock and make a lot of options access much easier and easier for people to understand, which we can get into a bit. Yeah. And as that happens, I think access for them and the growth of those are going to continue to go exponential. Interesting. And so I think, again, Robinhood is doing some of this stuff now. A bunch of other platforms are starting to really accelerate some of those offerings and simplifying kind of structures that allow people to be more non-correlated. So I think that move towards there is one of the biggest themes you can focus on. And importantly, back full circle to your reflexivity argument, two of those, and eventually I think crypto as well will have dramatic reflexive effects and are on the actual movement of markets themselves. And so if you want clues onto how this is going to end, it's not just about the bubble, and we have a lot of clues about how those operate and why and how they end, but you have to also look at this secular move that's exponential and pretty dramatic into some of these non-correlated products. And I think if you look at those two things together, there are some major themes and clues to how this might end up the next several years and really the next decade.
As you're speaking there, if you think about it, you're talking about the growth in the size of structured products, hedge funds, gold, equities. And I mean, over the last 5 years, say since the end of 2019, you might be able to approximate it, but how much in kind of paper wealth has been created from just this revaluation of all these assets? I mean, I suppose the question is, how much is it just people getting more optimistic, bidding up the price of the assets, and how much of it has been driven by just liquidity injection? Probably impossible to differentiate between the two, but I mean, part of it is kind of a real phenomenon, and part of it is just more optimistic asset valuations.
Yeah. So the reality is the biggest provider of liquidity, we talked about the gas in the airplane, right, is actually markets themselves. So this is where the airplane
but they need an initial
injection
down to get it going,
Yeah. Once markets go higher, they actually create more collateral, right? So it's a loop. If I buy a piece of real estate worth $100,000, and it goes, and I let's say I put $25,000 down and get 75% mortgage on it. Well, guess what? If that property goes to $1 million, how much collateral do I have? I have $925,000. in collateral. And if I want to make the same type of bets or make the same type of money, I need to put that money back to work because I'm not at the same leverage level. I was 4-to-1 leverage. Now I'm basically back to 1-to-1. And so the machine creates more collateral, which creates more ability to get leverage. And this whole system is leverage, by the way. I mean, people are like, most average investors like, I just buy stocks. There's no leverage in my portfolio, but the whole system is built on leverage. You have to understand banks themselves, like 10-to-1 levered, from the Federal Reserve and assets. So the whole thing is it's leverage all the way down. And so every time markets go up and more collaterals increase, the amount of money supply increases dramatically. And I just mentioned $500 trillion in assets. Well, guess what? If the market goes up 20%, that's $100 trillion more in assets. QE's got nothing on the liquidity that markets can or take and also, take away. And that's why, as much as the Fed and people say, oh, we don't manage the market. Well, if you manage liquidity, you manage the market because that's actually the greatest source of liquidity in the world. It's also why you often, it's silly, the market, you often hear from CNBC or, Fox News or wherever you get your financial media, like, the market is down because of X or Y. But you know why? The reality is we had as you mentioned, late 90s, a boom, right, economically, on the back of the liquidity driven by markets themselves. And what happened the second the market went down? The second the market went down, 95% of tech businesses went bankrupt, and had a massive recession, right? People think the market is a result or shows the net effect of what's happening under the hood. The reality is it is more the dog than the tail itself.
Driver. Yeah. So, it begs the question, when does the supply and demand imbalance normalize, or when does supply start to outweigh demand? Are there catalysts? Is it just liquidity tightening? Is it market dynamics, market microstructure? How do you think about what are the signposts?
Yeah. So this time, because of the amount, usually if you have the Fed involved historically and the Fed is, let's say, independent, the Fed is more likely to react to an inflationary outcome with withdrawing liquidity or markets going too far too fast and the perceived potential risks of what could come on the other side of that, right? And those are often what force a removal of liquidity to start.
Yeah.
And then you get a slowdown economy, which pulls some liquidity out. And then the big part is the market, reaction eventually can undo the whole thing. Volatility products play a huge role, and increasingly more than ever now, but have always been important in the sense that, when vol is very well supplied to the market, despite liquidity being pulled from the market, it stabilizes things and can allow for other liquidity to come back in and keep supporting things. The thing that tends to happen at the end of a bubble, and we're starting to see it now, and is actually a big thesis for me and Options Land and what we're doing in the next year, is you start to see volatility increase into a rally. You see that structurally. And that happens because the moves up just start getting so big, right? A right tail event, if you're going to do, as we saw with Arthur Burns and Richard Nixon in the 1970s, if you're going to provide liquidity without care over the inflationary setup and without care for the potential risks of the outcome on the other side, markets will provide more liquidity and eventually you get in a loop. And so the ultimate check on that environment is inflation. It's the only real place that government can't fully control if they choose to make a decision. That is, they take themselves out of a rules-based or some type of forward-looking smoothing mechanism, which is what the Fed is put there to do. And what we're seeing, it seems to be a removal away from long-term worrying about risks for more financial markets, worrying about inflation. We're going to no longer use those rules to concern ourselves in the short term. Eventually they will come back and
bite you. Yeah.
Bite you in a much worse way in the long term. So my view is that this ends, and if we are going to go down this path, which we seem like we are from U.S. liquidity perspective, it ends somewhere on the other side with much higher markets, which create more potential energy, as I mentioned, higher volatility into the rally, which loosens some of the holding mechanisms, calls, the people are short on the upside will continue to go higher and vol will go higher, which will eventually make it easy for buyers of vol to come in and say, well, if we're going to make money on vol on the upside, then, well, pretty much a no-brainer to start buying these to protect, and replace stock. And so that mechanism, which always happens at the end, again, 98, 99 was one of the best times in history to be long-dated calls. You made money all the way up and you made money all the way down. And so that will unpin markets and then ultimately raise inflation. And I think we also know, just to be clear, people like that, why does inflation matter? We can, the Fed can do Project Twist and keep the long and low without inflation. What's the big deal? Like that's the real liquidity. Inflation doesn't really draw itself that much liquidity. And I think those that are in markets know you can't keep real interest rates that negative or negative really at all for quite a time, or that drives even more inflation. And that's how you get it to hyperinflation. I don't care if you're in the US government or anywhere else. If people can borrow money at 3%, and inflation is, let's say, 5%. And give it, everybody on the planet who has half a brain, every institution, every investor is going to go borrow money at 3% and buy the thing that's going to appreciate at 5%. And they're going to do it with leverage. And guess what? That doesn't mean the thing goes up 5%. Now it goes up 7%. And now we go in a loop the other way. And this is what happened in the 70s. We've seen this throughout history in lots of other places. This is why the Fed is so sensitive to inflation and why they have the mandates they do. And so we can whistle by the graveyard and ignore those realities. But at some point that is the ultimate check. And so my guess is that that's one of the best hedges you can do out here right now. And to manage this is to buy, the problem with break evens is they no longer, the inflation numbers themselves are controlled, but by things that are actually going to hedge against inflation. And again, that's why we're also seeing the debasement trade in precious metals and crypto as well.
Because it's interesting. A lot of people out there might say, oh, end of Fed independence or Fed independence in their mind. That's not good for the US. I don't want to be in the US market. But actually, as you say, in the short term, that means asset reflation as a means of priming the economy and boosting asset returns and, heading into the year of the midterms. But that goes for only so long. And you see inflation as being the thing that breaks that.
Correct. That's exactly right. In the short term, full control, right, of the administration, who is incentivized for a number go up, especially into a midterm and then eventually also presidential cycle. They are short-term focused. They don't, what happens in 10, 20 years may or may not be their problem. And they'll deal with that problem when they get there. And so the incentive is very short-term and, guess what? They have absolute control, or increasingly so. And if they do, then they get the outcome they want. It's that simple. Until they can't control it anymore and they're getting to they will eventually get to an increasingly uncontrollable situation.
Yeah. Well, that's the kind of irony about all of this. It's just the cycle, how you get these broad structural shifts because of what's happened in the previous kind of regime. We had central bank independence that central banks fought hard to achieve, which resulted in the Great Moderation, and low interest rates came down, and they came down so far that central banks and government started to borrow excessively. And now people are happy to give up that central bank independence and the inflation fighting credibility. But it's hard once you lose it. It's so hard to get it back, isn't it?
That's exactly right. It's short-sighted, short-termism. And again, it's all about incentives. Like guess what? The administration itself doesn't benefit from the difference of where things are going to be in 30, 40 years. They benefit from how things are going to be now. And so that short-termism is probably the biggest problem that faces the world in general. It's true for corporations. It's true for so many things. And candidly, yes, if you're predicting markets, as we said, it's not about fundamentals. It's about supply and demand. And control tells you who the big bully in the room who can push demand is, and you can have confidence that that's going to be the case, regardless of the long-term realities. That said, to your point, trust, right? I tell my son all the time, it takes a long time to build trust. It takes very little to lose trust. And, we're entering a world where we've taken a long time to become, a bit more kind of we can almost all laugh when we say shining city on a hill, but there was a point, right? Like that was at least a view that democracy and all these things were, were something special. And then people, came in large amounts to come and work and build a life and do things in what that was generally considered a fair, or life is not fair, but fairer place and way. And not to wax poetic, but like, I think it's fair to say people, myself, are a bit cynical about that these days. And that's, I think, just the beginning. People lose that faith, the whole breakdown in the thesis for why it works breaks down ultimately.
Yeah. And from an options market perspective, I mean, you talked about the right tail, you talk about the upside. Obviously, everybody's thinking about the downside from a hedging perspective, but as you say, we could see higher markets, higher volatility. What is the market showing in terms of what skew has been correctly priced and what is not?
So we started talking about this a couple months ago as being the next big trade, meaning multi-year trade. And the last month, it has exploded higher. And I think we get first inning on this one. And this is, again, long-dated calls are dramatically underpriced relative to the risks on the right tail. I mean, to take the debasement trade I just told you, right? Just from an inflationary perspective, the right tail is underpriced. Now take the supply and demand dynamics I just talked about, and institutions are net short, and liquidity is coming in and squeezing kind of all that, not to mention the growth of structured products. We're in the end of the year and institutions are underperforming. I mean, I could name 12 things that mean the supply and demand imbalance, the right is dramatically underpriced. Meanwhile, we're entering a bubble, and a bubble by definition is leptokurtic. It's not just a right tail. Eventually it leads to a left tail. And so if you want to manage your risk with the world massively long and try and diversify, we could argue gold and precious metals and crypto are no longer cheap, right? We can argue hedge fund strategies have their problems. What I can tell you is, an S&P call a year out or 4-6 months out on an 11-12 vol, given historic, long-term volatility in markets is average of 17, and given the risk we're talking about on the right tail, is it you're getting that hedge for a credit, and you don't get hedges for credit for very long. So, the answer is pretty clear to me is you replace any stock. Why would you own the whole distribution, right? Be short all that downside left tail, right? Be underweight, by the way, the right tail, when you can just go replace that with the cheapest part of the distribution in general, and particularly in this environment, which is the right tail. So add on the money calls, and you don't have to do it in the S&P, but there's a million other equity ways to do this, but calls are underpriced. And that's what we're seeing, by the way. We are seeing market up, vol up. Most people have played in this space who have not been around for the 27 years I've been around, haven't, I think if you came around in 2001, 2, you haven't seen this in, 25 years. It hasn't happened. You've seen market up, vol up for a week, which generally leads to an unpinning and a down move, and it's a good indicator for them. Nobody, I don't think, that has, it hasn't been here that long, has seen a continuous, long-standing move, meaning a year or so of that type of general action. And it's actually in the vol space one of the easiest ways to make money. So you are fortunate to be at a time where you're getting a credit in a way to hedge and improve your outcomes. And if you don't take it, I think, that's on you. Why at this point, I'd much rather have a 12 it's been very profitable already and will continue to be a 12 vol out of the money call with leverage to outcomes and not owning that left tail at this point. So stock replacement, easier way for people who are, if this sounds too complicated, replace your stock with calls. That's a much, much better way to play this in the next year or two. Not financial.
And what about,
advice.
I know we've talked about this before with respect to gold, but that was probably about 50% lower from here. Now that we've had this phenomenal rally this year, how is that market looking in terms of the distribution?
So I've said this in other formats, other places, but the most from 1965, 68, all the way to 1982 for 15 plus years, the best performing asset by far, it's not even close, was gold. This is before crypto, so you could argue some of this, is going to be somehow distributed across the two, but it wasn't even close. But most people don't realize it was also the most volatile asset during that period, and not just because it was upside volatile; it had a two-way volatility to it, and that's logical. We've been talking about this for several years now, and you and I might have talked about it. But everybody's focused on equity vol. The best performing asset, in a debasement era or a period of bigger structural inflation, is not equities. Equities went nowhere in 1968 to 82 because they're measured nominally, but that the inflation forces valuation multiple risk. So you have the push-pull on a nominal basis that drive net less volatility in a long-term basis. You have crises, so there's a role for equity. But the things that did incredibly well were FX, obviously interest rate vol, but FX and precious metal. And they're the same thing. If you think about it, FX and precious metal are integrally related. Like, precious metals are a currency. And so, if you really want to find hedges or find secular opportunities in this environment, that's where you should be looking. Precious metal vol, crypto. So I bring that full circle to what's crypto going to do? Crypto is going to continue to perform well, but it is not going to be a straight line, and it has been a straight line. So in the short term, it could still very much go vertical, and that volatility could continue. But similar to me, how I was talking about equity upside vol in the short term, I think calls are a lot more expensive in gold now, but I would say volatility broadly is still cheap relative to what we've seen relative to what we've seen in other periods like this. Again, if you look at it over past the last 40 years, you'll say, Cem, you're telling me to buy this gold vol, crazy vol. But the dynamics that are in play are going to make this a very wild ride.
I know you had a couple of thoughts around AI and a couple of themes related to that. Obviously, it's a topic that everybody's focused on in terms of a major driver of the market, and thinking about, is the spend going to be justified? I suppose has been a big theme in relation to the hyperscalers and technology firms. I mean, I know you see it having some impacts, both kind of on a trading perspective that could be quite meaningful. Is it going to be a game changer that's going to add value, do you think, on the trading side?
100%, but in ways people are not betting on, and that's an opportunity. I think the way people are betting on AI is very one-dimensional. It's very kind of first-order thinking. And by the way, the same thing that happened in the 90s. The first-order thinking in late 99 or 99 was, the internet's going to change the world, so go buy the companies who do all the real-world things on the internet. Go buy socks.com because they're going to take over the sock business. And guess what? All those companies are bankrupt and lasted only a year or two after the bubble, right? And that's not who ultimately ended up winning. Actually, who the winners would end up being, we had no idea how that would evolve, and from search, and then eventually, right? ISPs were trading at crazy multiples. I don't even exist anymore. So the point here is there's a lot that we do not know yet in terms of the evolution of AI itself. And honestly, we don't need to play that game because a lot of that will get commoditized. I would argue that the value of AI and the profits of AI are actually probably not going to accrue to AI itself. I think that becomes a commodity at some point. Think about the real world. I mean, we have lots of bright people all over the world. A lot of people are a lot brighter than me. I'll tell you that. My value that I am able to provide, which in theory has like real value, is not intelligence. It's my history, my knowledge of which is very unique, right? And that unique experience, intelligence can then use to create real value. So data sets, unique data sets are going to be incredibly valuable, particularly in places where that data can be used to generate efficiency or more, new ideas, new technologies and things there. So, the data itself is being dramatically undervalued. And then lastly, the inputs, right? At some point, the thing we can have great confidence in is we don't know where AI is going, but we know what its inputs are and what it needs to succeed. And this is where kind of energy and power, come in. And the data again is the other kind of input. So that's a real focus for me broadly with AI. The other big focus more broadly with AI is if you think about this, who's going to be the next platform, right? The intelligence itself will be commoditized. Like the cell phone itself is commoditized, right? But Apple is a tremendous stock because they were able to lock in kind of a platform that everybody didn't want to switch off of. And so the question is, who's going to be the big AI platform? And that's hard to judge. And there's a lot of different places. I have my opinions. But my guess it's the one who controls data, again, for individuals and for companies, or manages a security of data, right? And I think that's, again, a critical theme. But what areas, so let's go a step further. What areas where is data, unique data sets available, and where is the greatest potential for taking that data and creating a value. And one, I think that's one of the worst, ironically, one of those areas is the cheapest area in markets, or one of them, period, which is healthcare. It's a science. It is the science. And it is the place with some of the greatest costs, particularly here in the US, on the system. Why is it so inefficient? I don't think many people ask that question. Why is healthcare so inefficient? It's a science. And the answer is we have very strict rules around healthcare data. Data is locked up, sequestered in very unique places and very hard to access. If we didn't have data privacy around healthcare, guess what? We have no data privacy really anywhere else, but we oddly really think our healthcare data is critical. And I'm not saying it's not. I think privacy is super important in general, but we've kind of already gone over that. I think we've skipped over that. And so my point is, HIPAA aside here in the US and regulations on healthcare privacy, otherwise, there are places where that healthcare data does exist and can be used. United Healthcare, for example, is one of the greatest owners of healthcare data in the world. Oddly, they're worth not so much right now. And I think again, it's not necessarily people want to say AI. It has to be an AI play. It has to have AI in the name. But really what you want to start hearing is who has data in the name, who has unique data sets in their name. And I think that could be a real theme that people could start to catch on to here in the next couple of years. But the reality is that's also, those things are cheap and have much less downside. So I think the asymmetric things like that are really, really critical. Another place, and this is more my domain now, is new technologies or things that are complicated, or are having a hard time, are better technologies, but are having a hard time with getting distribution to the world because they might be complicated, or they need a translation. There's a bunch of different things like this in financial markets, and this is kind of what you're alluding to. Options, right? Options are, we've talked about this at length, and people about 4 or 5 years ago, I started saying this, and kind of a lot of crazy looks. Like options are the true underlying, in the sense that they are not a two-dimensional up-down. They're not just an expected value of a distribution. They're every moment on a full distribution of any and every asset in the world. It is, like taking trading from two-dimensional world to a three-dimensional world. It is superior. It's not like now people, it's confusing to people because you're dealing with 3 dimensions instead of 2. And guess what? That needs to be made more accessible so that our minds, it can be more logical, more easy to manipulate. Take what's in my mind and what I actually want and translate it to how to get more precise positioning based on that information. And that's happening. And that's going to happen in spades the next year or two. I think options will become much more accessible. I kind of liken it to electricity. When electricity was first discovered, like, people were terrified by it. This incredibly powerful thing. You're not going to bring it into your home. People still use candles at home for many, many years. And it was really hard. They had to standardize and find a way to translate this powerful thing into just a simple thing that people just plugged in something and never worried about it. And there's a million technologies that do this. Actually, most technologies need this. They need they start in the raw, and they're truly worth a great value, but you got to get network effects. You got to get to translation mechanisms. And this is what's happening. And it's already been happening in the options market, but AI unlocks that so quickly because it really
who are
is.
the winners in that? It's just, again, it's the platforms who embrace that and build a user interface. Is that it?
Anybody who is involved in options, period. It is a taking over of that whole market. It is also, by the way, accelerant to those other things I talked about, to moving to non-correlation. So I wouldn't say the structured product industry, but those who step in and provide those at cost, right? Or at, which could be the exchanges themselves, which could be the brokers themselves. I actually really like brokerage exchanges because they're also not inflation sensitive. There's no input increase. Profit margins increase in times of inflation because revenue increases and costs don't. So brokerages, exchanges deal particularly in the alternative space. Any educators, people who enter this space and become more involved in it more broadly. Technology platforms that help, with this translation. And importantly, you could invest in the actual assets as kind of his first order, but there's also market effects that are going to come based on the structural changes in markets going forward too. So those that trade in these are market makers, entities that trade in these spaces will benefit as a function of that as well.
So it sounds like, with those types of things, obviously the gains accruing to those with the best technology who have already the resources. Is that a reason to think it'll be in our business that the pod shops, the bigger houses that already have, or the QRTs, the ones investing massively in technology, will just continue to get bigger? Is that the implication?
Not really. There's a push-pull, right? Because the edges are decaying because AI takes away some of the, the value of that knowledge, right? It's no longer like as we're talking about data set, your data set's kind of becoming commoditized. That said, you have a massive, early on, you're going to have a tidal wave of new entrants who are, just using AI and less sophisticated and entering a space, and that might create more bid-ask spread in some ways as well. So I think there's a push-pull. I mean, it's no different than since the beginning of time and markets and options. I started in the market. We had, dollar-wide markets and S&P options. That was very profitable. But guess what? And by the way, that was more segmented, marketplace, because a lot of people could just go do that. You didn't have to be that sophisticated to get a bid-ask spread. Nowadays, though, the volumes are through the roof, right? And the edges have come down, but there are a lot of entities that they're sophisticated enough who are making more money than ever. So I think the winners and losers will change. That is for sure. But I do think it will, in some ways, be much more profitable. And if you're playing it from a much more, who's going to win is people like RIAs who are taking advantage in this trend early, because that whole industry, in my opinion, is changing quickly. And you got $500 trillion. That's one of the biggest industries in the world. That's a place I'm playing in and trying to be part of as a function of that. So I'm kind of talking my own book here, but I do think there are tremendous opportunities for that tidal wave from just two-directional world to three-dimensional. And that transition will be made much easier through AI and other technologies.
Well, definitely that's something I'm thinking about. I mean, increasingly, I think we will see a blurring of the traditional and alts investments. I mean,
absolutely,
it's already happening, and over time, I would expect it to accelerate. And what you're talking about, obviously, with options trading, would accelerate that. I mean, maybe not. It seems like hard to believe we get even more retail participation. We've already seen plenty of retail participation in the options market, but in the US, I guess we could see even more.
Yeah, and when I say retail, I retail is actually relatively small. I mean, it's gotten big, but relatively small relative to, because when we say retail, we're talking generally smaller traders, right? Like that, or smaller numbers, right? Robinhood's average account size is $4,000, right?
Correct.
What I'm talking about is RIAs and the big pools of assets, and that is quote unquote retail. But that is not a small pool of assets. That's the biggest pool of assets in the world. And this is why, again, ETF issuance with options in it, for example, right? Which is a kind of I don't think that's necessarily the final step. I think but that is a trend that's going to just keep going exponential. We've gone from $20 billion of those just 3 years ago. I'm talking about the most vertical trend to 20 billion to 300 billion there. In just 3 years. That's not a 3x, right? That's a 15x. And I think that type of growth there is just getting started as well.
Conscious of time, and I wanted to get your perspective on, how the timeline looks from here in terms of event risk into year end. Obviously, speaking to you before, you'll often talk about the summer period, vol compression over that period. Now we're gone beyond that. We've got the Supreme Court starting to take arguments on the tariffs in November, and there'll be a ruling sometime after that. So that's obvious risk around that. But I mean, as you look kind of next number of months, have you mapped out a timeline in terms of possible risk dates?
Always, and it's easier to do. And the reason seasonal patterns don't really care about, what's happening in the government or what's happening in XYZ is there are structural pressures that drive outcomes much more, and particularly at this end of the year period, than the headlines. Now, the headlines can affect things if they're big enough, right? A nuclear bomb goes off in New York, there's going to be a market reaction, right? China invades Taiwan, there's going to be a reaction. That said, in the absence of some massive left tail event, and even I would argue in the context that we've seen many situations where those happen and the market still does its thing until those flows are gone, and then it reacts. Think COVID, right? Like we knew about COVID in December, but we didn't get a decline until February because the flows, February OPEX to the day because of those flows. So I prefer to talk about the flows, and particularly here in this period as we enter October and start looking forward to the end of the year. I want to reiterate, again, it all goes full circle here. Structured product issuance is dramatically bigger than it was last year. Hedge fund long short equity is significantly bigger than it was last year. And those are also, so it's not just seasonal, every year the XYZ happens. These effects are getting bigger. Okay. And this year we also have a now beginning and heading towards the takeover of the Fed, which is coming in May in full for next year. And markets already know it. Importantly, markets already know it. So it's already kind of put in place there. So liquidity is coming. It's already on the way. And unlike, let's say, last year and most years, institutions are caught underweight. So you have a recipe here of supply and demand dynamics that are not in your favor. This is a bullish period in general when markets are up. Why is a bullish period in general when markets are up? Markets are up 15% for the year. You have $200 trillion of equities. That's, again, a $30 trillion input. And about 10 or so % of that at a minimum goes to work Gen 1. $30 trillion, 10%, $3 trillion. The average amount that moves markets on a daily basis, is about 75 to 100, let's say $100 billion now. You got a $3 trillion buy order that's sitting there Jan 1. Is it a surprise that the Santa Claus effect and the January effect together, those 4 weeks, are the most positive 4 weeks, month of the year? No. And so an up market, the more the market's up, the more that the direct's up. Okay, so that's one. So that's sitting out there. It's still Jan 1. We're in October. I get it. Like, that's a lot to play that trade now, but it's sitting out there. And institutions are underperforming. That Jan 1 deadline presents a problem, right? They need to get end of the year. People start looking at their statements saying, wait, how much have I made? How much have I not made? Do I want to stay invested? And those decisions come up. And guess what? You got to start, given these dynamics, people can't wait. And that's why you keep seeing the consistency of this rally as we push into the end of the year. Okay. And institutional position was at the 0th percentile in June. Now it's at 25th. Dramatic move, but you still have way to go, right? Yes. And they're underweight. So like, you can't catch up by being even weight. You need to be overweight. And so you have those dynamics at play. And now you have structured product issuance, which is bigger than ever. And we saw that this summer. We saw it last summer. And what that does is that drives compression in general. But during a September, October period, or maybe even August, when there's more volume and things going on, it has less of effect. But what happens when volumes get cut in half and people start shutting up shop? Well, that structured product issuance has twice as much effect. That vol compression has twice as much of effect. And that's what we see in the summers. That's what drives that summer of George effect, which itself is bullish, because then there's this skew in markets, right? And then there's more open interest than ever out there, right? And all that open interest leads to decay as that happens. And that's a bond charm flow push up as well. And bigger than ever, because it's not just the amount of vol compression, it's the amount of these structured products out there that need to be rehedged. That's the amount of charm flows are bigger than ever. You put all this together, and then you have, again, historic liquidity that's like an administration who wants it higher. Do you want to be short this market? I mean, yes. Could we get a headline risk? And by the way, the reason institutions are underweight, reflexivity, again, let's go full circle, is because we're in a bubble. And the natural thought in the bubble is, I got to be underweight. This is crazy. This can't keep going like this. Or I'll miss the upside, because I don't want that left tail risk. Well, okay, but at some point you get pushed back in.
Yes.
And so, reflexively, this setup is very bullish here as we enter the end of the year. And that goes till about the middle of January. After that January effect and Jan OPEX comes. And then things can get some mean inversion, but we're also going into a midterm year, and there's all kinds of other incentives in play to keep the plate spinning. So, you want a general roadmap, and it rhymes with a lot of the years, but I'd say this year it's on steroids. It's market up. Probably gets front run because markets don't wait. That's what's been happening here. They don't let you back in, and then maybe December, like that normal seasonal period, which people have caught kind of on to, gets front run, and maybe then that period is a little kind of sideways, and then again, if you look at the price action last year, it was very predictable. We said that similar things last year with less of these dynamics at play. And my guess is that this goes even faster because the dynamics are more short, institutional, and there's more catch up and there's more liquidity at play. But steep at first, less steep at the end. Eventually some type of pullback finally, probably in February or January. Maybe it gets front runs at Jan OPEX, and then that'll be people want to get back in because they see the end of the year midterm thing, and there'll be some support regardless of but the whole way volatility is going to do one of these longer term this owning calendar vol, which is very compelling, and that's part of why the curve is so steep, but it works incredibly well. And so, I think those are the general dynamics. We can talk about what happens after Feb, March, or whatever next year when we get there. But, for now, as the French say, laissez bon temps rouler, let the good times roll.
Very good. Well, that's a good note to finish on, a very upbeat note for anybody heavily invested or not. Well, Niels is back next week, but Cem, thanks very much for coming along today. Always a pleasure. As I say, Niels is back next week. If you have any questions, feel free to send them in. And we'll be back soon here on Top Traders Unplugged with more content.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.